Since the Great Recession of 2008, lower middle market merger and acquisition world has never really recovered its expected rise. The advisory community expected a bit of a tidal wave to follow in the post-recession years, but that hasn't materialized to date. You can see it in the data. Fewer owners have sold than expected. Transactions are taking increasingly longer to close, and more deals are delayed in a market that feels, frankly, kind of perpetually hesitant. So while the media headlines and industry white papers blame economic uncertainty, elections, and interest rates, I believe there's something deeper going on. The real issue isn't financial, it's personal. Most business owners lack a great personal plan for what comes after their exit. And when you don't have a purpose beyond your business, that internal uncertainty that you feel deep in your core becomes a reason to cling, not to create. The first quarter of 2008 was, unfortunately, the time when I exited my manufacturing consulting business and I decided to step squarely into the world of merger and acquisition advisory. And then nothing happened for me for 3 years. So believe me, few people were watching the nation's economy sputter with the same level of panic that I was. Following the 2008 to 2009 recession, the merger and acquisition industry expected a bit of a catch-up wave of owner exits in the years that followed immediately after. But interestingly, that wave never seemed to materialize. Now, I'll acknowledge there have been blips in that trend of exits, particularly in the 2021 to 22 period tied to COVID, which was obviously the most uncertain time of our generation, and many business owners had kind of had enough of the stress of entrepreneurship and decided to exit. I'll also acknowledge there are other factors at play. Yeah, owners have stayed healthier longer. Strong business conditions kept them comfortable in that CEO or president or founder's seat. And yes, technology advances have made it increasingly easier to run companies remotely from a laptop in Florida, Arizona, or Europe, particularly during the winter months. But after plenty of research and conversations with business owner clients, I've come to understand and believe that the real undercurrent here isn't being talked about or acknowledged. The deeper undercurrent hasn't been economic, it's existential. Business owners and leaders have looked around and said, the world is spinning increasingly faster, and I don't know what's next. And no one's helping me plan and think through who I will be after I exit. It's not a dollars and cents problem, it's a meaning and purpose problem. So here's what the data really tells us. When the external world feels uncertain, we as humans cling to what's familiar. New York Times global opinion writer and best-selling author Thomas Friedman was the first to identify this broader issue in his famous book, The Lexus and the Olive Tree. As humans, we tighten our grip on the things that are known in our world when the unknown or the outside feels ominous and dangerous. And in the last decade and a half after the recession, business owners have faced nothing but uncertainty. Increasing political polarization, global tariffs now, pandemics, wars, and the relentless accelerating speed of technology. So what do entrepreneurs do? Like the rest of us, they hold on to their companies like a life raft because that business isn't just their source of income, it's their source of identity. Without a compelling next chapter and personal plan, that which is known begins to behave a bit like a shield, right? In another book written by Friedman called Thank You for Being Late, he highlights the creation of Dr. Astro Teller of Google X. Now, if you're not familiar with Google X, that's Alphabet Corporation's innovation lab. So you can imagine some fun stuff is happening there, right? Dr. Teller created what is now dubbed the rate of change diagram. In this, Dr. Teller suggested that the global rate of change outstripped the average person's ability to process that change. And in his theory, that happened in 2014. That's right, over a decade ago. So here's my opinion. The lower middle market exit landscape hasn't struggled because of valuation, interest rates, or the lack of buyers. It struggled because sellers don't have a great plan for their purpose in the next season of life. Now, unfortunately, in the professional community, most advisors build transaction plans, not transition plans. We calculate enterprise value, but we never help owners discover personal value. And without that emotional readiness, owners subconsciously delay. The known of the business feels safer and like a better bet than the unknown of the next season of life. So here's the good news. This is where Dr. Viktor Frankl's logotherapy becomes so relevant today. Dr. Frankl taught that every human being is driven by the will to meaning, the innate desire to live for something bigger than themselves. And over the course of their careers, many business leaders find the will to meaning in the day-to-day of leading their companies. However, when that will to meaning is ignored or undeveloped, the void doesn't stay empty. It fills with anxiety, fear, and scarcity. And scarcity mindset kills merger and acquisition deals faster than market forces ever could. Now, think about it for a moment. If a business leader doesn't have a clear sense of their purpose, who they'll be after they sell, then every conversation about selling actually begins to feel like a conversation about dying. Now, most people won't say it that way. They don't articulate it in those words, but emotionally, that is what's happening. In my advisory career, I've honestly only had one client who volunteered this truth to me. After he was first that honest with me, I've had to pull it out from others in conversation. But that conversation with that first client, he was the owner of a plastics manufacturing business. He told me, Andrew, each day since I signed that letter of intent, a little piece of me dies each day. Now, unfortunately, he wasn't open to a deeper conversation in the moment about what his next purpose was. Both he and his wife were experiencing significant health issues, and that was as far as he could see. But without purpose, liquidity feels like loss. Without meaning, freedom feels like fear. And so business owners delay, they rationalize, they tell advisors like me, well, maybe next year, or let's just wait until the election's over. But what they're really waiting for is certainty, both in the markets and in themselves. And since neither of those ever fully arrives, they stay right where they are and they wait. The bottom line here is, this is why the M&A industry has been slower than expected for almost 2 decades now, because owners are psychologically unprepared for life after their company. In my book, The Second Wave Life, I write that every entrepreneur must prepare for 2 exits, the financial exit and the existential exit. Now, the financial one is measurable. The existential one is meaningful. Most owners plan for the first, but they ignore the second. But the truth is this: it's much, much harder to let go of and then sell the business identity until you've started building another one, the personal identity. That's where the frameworks, like what I call the 4 T's, your tribe, talent, time, and treasure, come in. They help owners reconnect with who they are beyond the balance sheet. This work isn't optional, it's essential. Because without a compelling next purpose for the baby boomers and Gen Xers, I don't foresee an amount of deal flow that's going to jumpstart the market forward. The lower middle market certainly doesn't need more buyer capital to make it go. There's plenty of data that shows what has happened there. What we need is advisors, investment bankers, and exit planners who ask better questions. Not just, what's your number, but What's your next purpose? When we ignore that dimension, we create a generation of owners who fear the void more than they value the opportunity. The famous cliche in the M&A business is, time kills all deals. But I've learned from experience that it's more about fear. And when fear leads, deals die. In other words, the M&A industry has spent the years post-recession trying to solve an economic problem with financial tools, when the real issue here is existential. Owners aren't stuck because they're indecisive people. They're stuck because they're uninspired. So here's my challenge to advisors and owners alike. Stop treating the exit like a finish line. It's actually the starting line of your second wave. So reignite your purpose, reinvest your talent, re-engage with your communities or your tribes, as I like to call them. Because when you plan your purpose as intentionally as you plan your payout, you don't retreat from your life, you actually re-enter it. Viktor Frankl wrote that life is never made unbearable by circumstances, but only by lack of meaning and purpose. Look, the M&A market doesn't need more liquidity. It needs more meaning. And until owners discover that, I believe that deal flow will be slow and deals will continue to stall. But if and when owners do discover that, when they finally create great personal plans for their next chapter, we won't just see more exits, we'll see more awakenings. If you're interested in learning more about what you heard, please use the link in the description to visit the website, and you can receive the first few chapters of the book for free.